Today, we're going to break down how hard money loans work, specifically in real estate deals like fix and flips and short-term projects. In case you haven't seen our channel yet, I'm Aiden Wong, a hard money lender with RSC Private Lending, who's lent hundreds of millions of dollars to real estate investors over the past few years. Hard money loans are often misunderstood. People hear that they're expensive, risky, or only used by desperate investors. In reality, hard money is a very common financing tool used by experienced real estate investors to move quickly and get deals done that traditional banks simply can't handle. By the end of this video, you'll understand what a hard money loan is, why investors use them, how the numbers actually work, and why expensive money can still be profitable. So let's start this with, what is a hard money loan? A hard money loan is a short-term real estate loan backed primarily by the property itself, not your personal income or bankability the way a traditional bank loan works. These loans are most commonly used for fix and flip projects, auction purchases, short-term real estate investments, or time-sensitive deals. The biggest advantage of hard money by far is speed. Traditional banks can take weeks or months to approve a loan. Hard money lenders can often fund in 10 days or sometimes even less if there is an existing relationship. So why do investors use hard money? Imagine you find a property listed for $500,000 and it's a great deal, but needs work and needs to close quickly. A bank mortgage won't work here. The property may be in poor condition, the seller wants a fast close, and the underwriting process takes too long. Unless you have $500,000 cash, you need a different source of funding. That's where hard money lenders come in. Hard money lenders specialize in fast closings, short-term loans, real estate-backed financing. So why is it called a hard money loan? It's called hard money not necessarily because it's hard to get, but because the loans are secured against hard assets. And although it generally comes with higher fees and higher interest rates and shorter loan terms, it allows you to execute the deal. In real estate, missing a good deal often costs far more than paying higher interest. So let's walk through a simple example. So we have a list price of $500,000, a renovation of $100,000, and an ARV after repair value of $800,000. So $800,000 minus out our list and reno price leaves us with a gross potential profit of $200,000. But of course, it's not that simple. A loan of $550,000, which is 90% of the purchase plus 100% of the renovation. They'll take first possession on the property itself and then offer a 12-month loan term, which comes with no prepayment penalties. So what exactly does that mean, first position? Being in the first position means the lender gets paid first if the property is sold or foreclosed on. If there are multiple loans on title of the property, the first position always gets paid first. The second position gets paid next. And if there are any lower or junior positions, those carry a lot more risk. Because the first position is safer, lenders prefer it and oftentimes require it in order to give out a loan. So when we're talking about the percentage of the purchase that a lender is willing to give, that is called the LTV, or loan to value. So loan to value refers to how much the lender is willing to loan compared to the property's value. We offer 90% of the purchase price or 90% of the as-is value. Other lenders may require even more down payment, around 15 to sometimes even 25%. Requiring borrower capital reduces our risk in the loan and ensures that the investor has their own skin in the game. So let's go back to this example deal and talk about some of the costs associated with the loan. So on this $550,000 loan, there's going to be generally 1 to 3 points. Let's call it 2 points up front. What points are, these are a percentage of the loan that you're paying out to the lender at the closing of the transaction. And this is for legal costs, due diligence, and their own risk for doing the loan. And so this 2 points, or you can say 2%, is paid upfront. And if we're looking at a $550,000 loan, that equals $11,000 that's paid to the lender. On top of that, you have the interest rate, and the interest rate generally is between 9 to 11, sometimes 12%, but let's call it 10% for this example. And this is annualized interest, which is paid as interest-only monthly payments. And there's no prepayment penalties for these loans. And so if you're only in the loan for 3 months, you only pay for 3 months of interest. If you're in it for 12 months, you pay for all 12 months of interest. All right, so let's look back at this example scenario we have. Let's say we sold the property for the estimated ARV of $800,000. Let's work backwards and see what our profit would be using a hard money loan. So $550,000 is the principal that's repaid back to us. And then we paid 2 points up front. And so let's minus that out as well, 11,000. And then let's calculate the interest here. So again, we said that this is 10% interest. And for the sake of this example and making it easy, we're going to use Dutch interest. We'll do another video later on where we can dive even deeper into the difference and see really what difference that makes. But let's say this is a Dutch interest loan at 550,000. So we're just going to do 550 times 0.1. That's how we can calculate 10%, right? And that gives us 55,000. But that's not all the interest that we need to pay if we're only in the loan for a shorter period than 12 months, because this calculates annualized interest. So let's say we're only in it for 6 months. So that's half, right? 27,500 is paid in interest. Okay. What other costs might we have? Let's calculate for selling costs. There's 6% in realtor fees. And then let's say there's 2% in miscellaneous purchase, and then 2% in miscellaneous selling. So the realtor fees, 6%. Let's start off with that. 800,000 times 6%. This means off of the sales price, 48,000 is going to realtors. And then we have the 2% purchase miscellaneous fees. This can cover if there's transfer taxes or your insurance costs or escrow fees. So we have, and remember, this is going to be off the initial purchase price, 2% of the purchase. So we have 10,000 for that. And then 2% of the sales price, again, it's different. So this is going to be off the 800,000, 16,000. So let's add this. And then the 2% miscellaneous selling costs, put here as well. And I mean, this could be anything from staging costs or concessions that you have to do, whatever. And so when we calculate it, let's just go back and start off from the top. We have the 800,000 sales price minus the 550 principal repaid to the lender minus 11,000 that we had as the points we paid at the purchase, the 27,500, which was the Dutch interest over 6 months, 48,000 that goes to the realtors, 10,000 as the miscellaneous purchase fees, and then 16,000 as miscellaneous selling costs. And then we look at a total profit on this deal of 137,500. So again, this $137,500 profit is with all of these costs, and then you're only in the loan for 6 months. That's why we paid half the amount of interest that you would have paid if you were in it for 12 months. So if you're in this project longer than 6 months, the profit would go down. If you're in it for less than 6 months, your profit would go up. So again, make sure you calculate based on how long you're in the project. If you're interested in learning more about hard money or want to apply for a hard money loan, go ahead and click the link in the description. We'd love to chat and help you out.